Welcome to the source of commercial real estate. And listeners, today we are just going to get right into it. Deborah, tell me something you believe about real estate that might surprise listeners.
I think the real estate market right here, right today, is bad depending on which sector you're in and is great in many sectors. And so it is still very, very competitive. There are still competitive prices, still competitive dynamics depending on the sector and the type of class that you're in. So you can't read everything that's on the front of the newspaper page. As we all know, real estate is a little more nuanced and a lot more local.
Well, that's a pretty provocative way to start this conversation. Why don't I go ahead and introduce our guest today? Listeners, thank you so much for joining. You are listening to the Source of Commercial Real Estate, where we interview the experts in non-residential commercial real estate so you can grow your business, find a competitive advantage, and use real estate to live the life that you want. Today, I am talking with Deborah Smith of the CenterCap Group. Deborah Smith is the co-founder and CEO of the CenterCap Group and heads the firm's strategic capital and M&A and execution efforts. Prior to forming the CenterCap Group, Ms. Smith was co-head of M&A and a senior managing director with CB Richard Ellis Investors, $40 billion in assets under management on that side of the business. She joined CBREI in July 2007 to co-head the build out of the firm's M&A efforts and led the firm's negotiation and acquisition of a majority interest in Wood Partners, one of the largest multifamily developers in the United States in 2008. From 98 to '07, she worked on mergers and acquisitions with Lehman Brothers, Wachovia Securities, and Morgan Stanley. She has been involved in more than $100 billion worth of mergers, acquisitions, and restructuring transactions. She has degrees in economics and law from the University of Sydney. So we get to listen to her beautiful accent today.
Aw, thank
Deborah, thank
you.
you so much for joining me today. I already hit you with one question, but how are you doing today?
I am doing great. And that was so nice of you to say. Thanks for the intro. Much
Uh,
appreciated.
Deborah, you already hit us with a little bit of some of the value that you're going to deliver today. I am going to dive into some of what you hit on, but why don't we first start out with a little bit about your background and what your work looks like today?
Well, I've been an investment banker for around 25 years. I graduated from college and I started with Morgan Stanley, and I'm one of those people that kind of stuck with it. There aren't that many of us that are still from my initial class that are in the business today, but I've stuck around and we've built our business on the back only of real estate. Our firm, CenterCap Group, has been around since 2009, and we focus on mergers and acquisitions, primarily of investment managers, owner operators, developers, property managers, etc. Anything that's in the real estate space. We do private placements and capital raisings for programs, and we do consulting. And the consulting essentially covers how to get your business from a billion to 5 billion of AUM. How do you think about succession planning? How do I value my company? How do I figure out how to progress and set my org structure so that I'm planning for success in the future? So it's a very broad-based business, but what it does do is it allows us a lot of insight into every facet of what's going on, to be in the middle of the flows of capital, which is what drives the industry. It's where they're coming from and where they're going, as well as back the other way. So it's a unique business model. I don't know of another firm that quite does it the way we do, but it also means that it's a lot of fun. And when I hear something more than once, I start asking the question, wow, that really is interesting. Hear it more than once. And a lot of times those trends turn out to be true, and people are thinking about it and talking about it well before they make the pages of the newspapers.
Well, you gave us a great summary about what your work in the Center Cap Group is focused on. Will you give us an idea of kind of who are your clients? Who do you work with?
Sure. So 2 days ago, 3 days ago, close enough, is we announced the sale of BH Management Services to Pretium, which is a 50 billion assets under management company. And BH is one of the largest property managers in the United States. They manage around 116,000 multifamily units. and single family homes is the space they operate in, so a true housing manager. Last year, we represented RMR, who acquired Carroll, which was a $7 billion asset manager. We also worked with Common when they did their merger with Habit to become the largest co-living provider and manager in the world. We did that. That closed last year. But so it's a lot in the housing sector. So I think that's one of our clear expertises. But we advise on any debt manager. We sold Pearlmark to Conning, which is the largest Taiwanese life insurer. We did last year as well. And so that covers a lot on the transaction side, but we also raise capital through programmatic, usually through programmatic capital. It could be for development, it could be acquisition vehicles, but they're material. These are larger vehicles with larger institutions. Is that piece, and we call those, they're the users of capital. But we also work with the providers. So we have a large insurance company coverage practice. We work with pensions, endowments, foundations, all of those folks too, which we call the originators, and behind the private equity shops, there are investors, and we tap into those as well, either as clients or as well as acting with them as a counterparty and bringing them into our transactions.
Deborah, why don't we get into what you're seeing on the front lines right now with your mergers and acquisitions and also the advisement that you're offering your clients? So, can you talk a little bit about some of the biggest challenges that your clients are facing right now?
Yeah, so the world's a little bifurcated on a number of levels. So there's the asset level, and then there's the corporate level, and then you've got your product classes across each one of those pieces. I think from a trend perspective, the asset level has been tough as a general matter, and I'll come back to my comment where I started originally that it kind of depends on the product. So things like industrial are very hot commodities right now. Whereas we know that office is struggling and certain parts of retail and certain parts of other spaces. So it is bifurcated. But what happens when the transaction environment is tougher and it's harder to get deals done is companies become very focused on their company. It's like, well, what are we doing? And if you're an investment manager and you're not putting out your capital and it's sitting there, then you end up spending more time on, well, what products should I be working on? How can I access and broaden my investor coverage base? Do I have a succession planning that I'm a founder? And this is very common in our industry. Do I need to start thinking about the next layer? Do I need to change my comp program to keep people? These questions get a lot more attention when there is a market where it's happening, when you're not running on the treadmill of looking to put capital out at a deal level. So what that's meant for us is at the corporate level, our M&A business has been very active, very, very active. Our consulting business has been very, very active. And those two kind of go hand in hand. And the capital raising, we've become very selective. And so it depends on, we've become down to what's the market we're looking for capital, what's the product, and not just multifamily, that's not going to cut it anymore. It's what are you doing in multifamily exactly? If you want to do housing, what does that look like and how are you thinking about it? And so there are some challenges that I think we need to be nuanced. And I think that's driven, as we know, the transaction activity is off. But, we didn't used to have to, it used to be just about a conversation. You'd get an allocation to real estate and you think, well, how do we allocate within real estate? With interest rates where they are, it's also, we have to fight against where capital is placing at the debt level. If I can, have money in a bank account for 5%, then that impacts how people are valuing real estate and what the return profile looks like. So now you have a double issue. How do I fight for allocation against the rest of the world? And then once I get that allocation, how do I get it into my product? And so that's creating some challenges in the industry too.
You talked about some sort of what I would call maybe existential challenges like succession planning of big firms. Are
Yeah.
there any, can you talk about any sort of current events? You just hit on interest rates. How or what kind of challenges? I mean, it's been well documented that Blackstone has been having some challenges, and plenty of large firms are handing keys back to the bank, particularly in the office sector.
Yeah.
There's potential to see have more challenges in multifamily as well. Can you talk about any impact of interest rates or other sort of current event factors impacting these firms?
Sure. On interest rates, which is at the crux a lot of what's going on with the transaction activity. So, a year or two ago, we had very compressed cap rates in pricing, and we had a lot of growth on the NOI, particularly in the housing space, because the market was good. So it's a double whammy when it comes to then where pricing is. There was an alignment with the interest rate movement because NOI was still moving up at a good clip. But and so owners and operators thought their properties were worth what they were before, right? Because if my economics are good and the properties are performing and the fundamentals are good, then my property should be worth the same. But the challenge is that if you're on the demand side, that higher interest rates means a higher cost of capital and you can't afford to pay the same. So as a result, you end up having with these big value differentials on what people were willing to pay versus what was acceptable to the seller. And I think what's definitely starting to pan out now is there has to be some movement, and it's not going to come from the buyer side because interest rates are where they are. And I can't remember in my lifetime in this industry where people were willing to change what a value add deal was or an opportunistic deal or a core deal. I'm not sure they're going to move those bars. So as a result, there is a disconnect. And I think as the market continues and we start to see some alignment on on fundamentals, where that direction of those go will ultimately determine whether sellers are willing to bring pricing down or whether they hold their own. And of course, you have the timeline may be taken away from them as we have debt maturities, and you can't finance at the same rates you did before. So then you end up facing the same issue as a seller, right? And so you have to refi debt. So what do? It's you either accept a lower price and you exit, you put more equity into the property because the financing conditions aren't as easy as they were before, but you've got to replace free money with a much higher interest rate on your debt. And that isn't easy to do. And so I think we're starting to see some correction as to how that is playing out. And I think that's where we're starting to see emergence, like more mezz products, more preferred products, as sellers are looking, or holders of owners of property are looking to fill gaps and not exit, take a lower LTV on their property on refinancing and putting in a slug of quasi equity in there in order to complete their cap stacks. So we're seeing some direction on that, as well as just putting more equity in, paying more for your debt. And then they'll ultimately be the case, well, if none of those work, do you just have to revise your expectations?
Can you walk me through the thought process of, as you're advising your clients, you just laid out a really nice summary of some of the challenges that operators are facing right now. This idea that their property is not worth what it once was. It's not worth what they thought it was going to be. NOI is not as high as they thought it was going to be. Expenses are way higher than we anticipated a few years ago. And then also this gap between what buyers are willing to pay, what sellers are willing to sell for. Talk me through the thought process that you go through with your clients, because there are some operators who are deciding that it just makes more sense to give keys back to the bank and that deals are not worth or able to be salvaged right now. Whereas there are other scenarios where you had mentioned pref equity and mezzanine debt, where maybe some deals are salvageable and it's just going to take some time. It's going to take a few more years for NOI to get where it needs to go, to hopefully get interest rates reduced. Will you tell me about some of the factors that you're talking through with your clients to decide what the right course of action is?
Yeah, it is definitely depends on the property, the market, who it is, how well capitalized, the financial wherewithal. What's interesting is I'm not sure a lot of the banks really want these assets back. And unlike what happened coming out of the GFC, a lot more of them would prefer to stay in and work it out. It's because, particularly if you're in the office sector, what is the bank going to do with it? What are they going to do with it, right? It's in the hands of folks that can manage these properties. And so an office is a really interesting example of a market of a sector to pick on in a way that, you know, folks, it has been in the doghouse as a sector since 2009. It's right. It never quite recovered. So folks on the outside who are looking in and say, well, you know, the office sector's in trouble. For folks in the industry, it's a little bit of telling me something we don't know. But at the same time, there's a lot of really good performing office assets. There really are. The office sector, depending on the asset, if you've got a Class A office building and it's in a good location, those things are full. It kind of depends what we're talking about within each one of these pieces. If you own 70s, 80s product, it's a little tougher, which is why it's spurring the conversation around conversions for the office space. But even if you take multifamily, it's got its own challenges too, right? So, you know, on the one hand, it came down and compressed the most on pricing. So people expect it has the most to fall and a longer way to come back. At the same time, we recognize we have a housing problem in the United States. So how do you reconcile those two? So you end up with 70s and 80s product that have low ceilings. Nobody really wants it. So what do you do with that product? And it's glut. It's holding up in the market. By the other token, you look at a market like it's some of the Floridian markets, some of the Texas markets are very expensive. You know, there are multiple bidders showing up for properties depending on where it is. And so I think, you know, it's following the migration patterns. We as a firm tend to work a lot more with folks where we think we can get something done. And so if you're in a sector that's in trouble, or we think that you've got a challenge in your project, we're less likely to take that on just because they're harder to get done. And we try and work with the capital where we know they're going to go. So I know for things like if you're in housing, if you're, you know, folks are looking at single family homes as a product and trying to make the yields work, there's a lot of interest in that in the institutional market. There's a lot of interest in dealing with affordable housing and figuring out how to deal with their housing issues in the United States and what that looks like. And then you have your typical value add apartment business where you buy an apartment, you value add it, and then you sell it off. So there's that segment, which is in some ways has had some of the tougher corrections. And then you've got development, and development, depending on who you talk to, there's oversupply or undersupply, right? So it kind of depends where folks recognize that Nashville is oversupply, but in other markets there's an undersupply. So it kind of depends on where you want to sit. So when we find opportunities, particularly on the capital raising side, we'll look at the very nuances of what the opportunity is. And then we will usually have a sense from the institutional market where the interest is before we take something on, because our goal is to get the biggest number of folks interested in a deal and to get something done in the least amount of time.
Deborah, you had mentioned the issue of banks and that many banks don't want these assets back. They are not property managers. They are not asset managers. In most cases, the current operator is probably going to do a better job than the bank would do at managing these. Do you have any tangible advice or suggestions for operators struggling, but needing to have difficult conversations with banks? What advice do you have for operators having those conversations?
Well, your advice was just pretty good. What you just said. It's the positioning to your lenders is working through it and finding a reasonable outcome where there's something in it for them, and there's something in it for you, right? You want time, but it's not going to come for free. And so it's figuring out what you can give and being rational in your approach to dealing with whoever is on the other end of the table. But going into it and appreciating that you probably are the best person to be managing it, because what are the alternatives? And I'm always, you get more with honey than vinegar. And particularly if it's a good property, if it is a good property, those conversations are a lot easier to run with.
Do you have any concrete examples of what banks are willing to do to work with operators and avoid a foreclosure?
Yeah, and we don't work as much in that space. But what I would say, similar to if you have equity in your deals, is they usually want more money in it, right? We want you to, if you want us to stick around, what are you going to do? Are you willing to put more capital into it? And where is your show of good faith to demonstrate that you believe in this property such that we should stick around too? And so, and that's what in some ways leads, again, some of these pref conversations and these and MES conversations, et cetera, and even finding GP equity. It's trying to find ways to put more capital into the projects, particularly if they're good projects, as a way of either filling the gaps or as a way of being able to continue working with lenders.
And by bringing more capital into a deal, is that where the pref equity idea comes in, or are they more interested in operator capital coming into the deal?
Yeah, it's a little bit of both. It's in my mind for us, we are trying to work with folks where they either need the pref equity or the MES, or we're working with folks that can offer it as a capital solution. And at the end of the day, on either side, you're looking for a good project with a good sponsor. And what that can look like is the deal is either broken or you've tried to recapitalize it, but the lender has dropped down the LTV on it and it's more expensive. And there's an equity piece that you've got, but now you've got this missing middle in there that how are you going to fill it? And you either can do it with your own capital or GP, or you can do it with PREV or some other form. And so the conversation we're definitely seeing today is, and it's more than I've heard it since 2009, since the GFC, is these concepts of gap equity and looking to come up with tiers and structures that can fit in that slug that's in that middle there.
Okay, let's try to look towards some of the positive things that you're seeing. In your intro, you had talked about depending on where you're sitting, the market could be looking great or it could be looking terrible. Some parts of the market are extremely competitive right now.
Yeah.
Will you give us some ideas about looking forward? Where are you seeing bright spots, either in terms of geographical locations, asset types, those types of things?
Sure. So on markets is always the south. If you head down, head down the south. It's kind of flocking. You go where population growth and where migration has been, and the southern states have been the big beneficiaries of that. Although I think the economics are for deals, and particularly in housing, is very strong in the Midwest. The problem is fighting an old, a legacy relic idea that the Midwest, that it struggles and that there should be cap rate differences and whether they perform as well at a property level. And I think similar to every market, no matter what state you're in, there is always a strong market. And this business is a local business. And so it always bothers me when people paint it as we're going to focus on a state or a submarket as opposed to focus on a neighborhood. All right, what's the neighborhood? And every neighborhood is different. And so it really should be a concept of looking at any state, pick your state, where are the best neighborhoods in that state? From a product perspective, I would love to be in industrial outdoor storage, cold storage, those sectors, even some of the self-storage, data centers, medical office, some of the housing spaces, the nuance, if you have solutions to deal with attainable housing, these nuanced pieces, there's a lot of institutional interest for them. And part of that, for your listeners, some commentary around it. It's if you remember the days when student housing wasn't really an asset class and people were talking about bed bath parity. What do you mean we're going to do 2 bathrooms for 2 bedrooms? I mean, what are you talking about? Or single family homes also was not an institutional class. And the reason they weren't is because there were a lot of smaller deals at the time. And the institutions can't deal with smaller deals because if they have to put out $100 million or $200 million and you're putting out $1 million, 2, 3 at a time, it doesn't really work. It's a long way for them to deploy the capital. And that's why the institutional market has gone to larger deals. But what's happened in these nuanced spaces is that if you get a lot of owner operators, they start amassing all these portfolios of smaller assets, and then you have a whole bunch of them with portfolios, I can bring those together. Then I have an institutional bucket because all of that together, someone has done all the work and then I'm the beneficiary of it. And so then you can also get some benefit that not only as the manager, because they need you, right? Because it's a smaller product, it requires as much more time intensive, but there is benefits to your scale. And that's how these classes become institutional. That's what happened with student housing. It's what happened with self-storage. It's what happened with manufactured housing, is they weren't institutional classes until there's enough owner-operators and entrepreneurs doing enough in those spaces that institutions can bring them all together as a portfolio, right? And create, then there's some portfolio value added from the roll-up. That's how you get there. So industrial outdoor storage is one of those classes right now. Cold storage is one of those classes. Medical office, just because it's where the market is, and data centers, yes, has picked up a lot too. And then I think manufactured housing. I think these sectors are super interesting, and I think there's a lot of folks on the institutional world who are very interested in them.
Deborah, you had talked earlier about your involvement in capital raising.
Mm-hmm.
So I want to ask you about what you're seeing on the ground from the people that you're working with to raise capital. But first, I want to talk about who we're talking about that you're raising capital from. Are these high net worth people, family offices, pension funds, life insurance companies? Who are we talking about when we're talking about the people you're raising capital from?
Okay, so it's bifurcated. On the investor side, because we will work with investors to find what they want. So an investor may say, hey, I want to invest in an iOS platform. I want to do it at the GP and I want to write them a check for, I don't know, $200 million. So they'll say, do you know anyone? And so then I know where those institutions are angling to go. On the other side of the table, if I'm working with an owner operator, which is usually driven by what I know the institutions are looking for, and then we'll say, well, we need to focus on these 5 areas. And then we'll go back. So a big focus for us is cold storage. We really like the cold storage space. Is that then we'll look for owners and operators and folks that are in that market. And when I think we've come across a party that is institutional enough to work with institutions, then we will look to see if we can work with them on raising capital for what they're wanting to do. So it's a little bit of a marriage between the two, a chicken and egg, because one kind of feeds the other. But in all cases, we do not work with high net worth investors at all. We don't work with individuals either at all. And we tend to work with checks. So if we want to do a capital raise, we're looking to target, big numbers, 100 plus, 200 plus, and create programs that are long-standing relationships between an owner and an operator and an institution.
The asset classes you mentioned earlier, medical, industrial, outdoor storage, cold storage, data centers.
Yeah.
Is it fair to say that there is an appetite from institutional investors into those asset classes?
Absolutely. Absolutely. You can put in housing there too, certain segments of housing. I think there's a lot of interest in single family homes. But then again, it's split, right? There's built for rent and then there's scattered site. And so it's nuanced too. Everything is nuanced because, with the growth of the industry and complete transparency and information is free, you can get it anywhere. There's a lot more room to create and see what somebody else has done and come up with a nuance or create an avenue to do something new yourself. And so everyone has their own mousetrap, so to speak. And it's just what that mousetrap kind of looks like. But I call it's the life of the niches right now. It's niches. Anything in a niche, talk to me. What's your niche? But it's a lot more interesting. But even in industrial, it doesn't have to just be iOS. I think there's a lot of interest in industrial in general. And it's all about last mile. And it's probably, and just for your listeners, I think what's happened there too, what's also driving some of these interests in some of these spaces that I've laid out, is that it's a crossover almost into infrastructure. And so we're seeing a lot more folks that are not traditional real estate investors coming into this space. And so whether it's infra, whether it's alts, whether it's mutual fund managers looking to expand a debt product. But there's a lot more folks coming into the space that traditionally were not large real estate players. And so I think it's increased the demand across the board as they look to fill out a channel or a lane. And then you combine that with the post GFC trend of the world becoming silo within products. It's driving that too. So that as a result, when folks think, well, last mile logistics, we want to do that, then everyone crowds into it. It used to be last mile logistics was part of a diversified fund. But now there's last mile logistics. And so everything piles into it. And so as a result, then you need more logistics players, and then the rest is history, and it keeps going round and round and round.
There's been a narrative over the last, say, 12 months that a lot of institutional capital has been largely sitting on the sidelines. They've been in a wait and see approach. Is that, first of all, has that ever been true? Is it still true? And what is sentiment from some of your institutional partners right now in terms of distributing capital?
Yeah, I think that is largely true. Largely true, if I had to make a broad sweep. That said, I think in part there's a lot of capital that is looking at a lot of these different products. And it's as much about finding the right players, the right fits, and the right way to play the changing market as it is about I'm sitting the sideline because, transactions are hard to get done at an asset level. And I think that's generally true. But that said, I think that's what's also driven the corporate level activity. I think that there's a switch from institutions or a growth in the number of institutions that are looking to partner corporate capital with limited partner capital. So not just cover deals, but want an investment in the company at the same time. So I think that trend is growing. And then I think there is a trend that particularly from big institutions, that if I'm going to write a large check for an owner operator or a developer or a manager, then I want a piece of the ups and a participation in the corporate, right? That's the price of my capital. So I think those are some nuances and changes, but those things take time because corporate deals take a lot longer to get done than an asset deal. People part with their companies a lot slower than they part with their assets. And so I think there's some nuances there too that's around it. But I think in general, yeah, there's probably in bulk that people are a little more cautious or a lot more cautious. But at the same time, we're having our conversations. And I think if I could find and pair what these folks are looking at on niche products, then there's folks that are willing to pull the trigger and do deals.
I'd like to get some really tangible advice or thoughts from you on the idea of networking, particularly with highly successful, high net worth, these people in institutions.
Mm-hmm.
And, there are people growing their firms and they eventually get maxed out with their own capital, friends and family, and they want to start networking, whether it's with family offices or someone like yourself.
Mm-hmm.
What kind of tangible suggestions do you have for someone really wanting to up their networking game and in working with these really high achieving people?
I think that networking is incredibly important. And I think what folks need to realize is that whether you're working with institutions already or whether you're come from the high net worth and you're trying to crack into the institutional world, there's a couple of different ways you can do it. As you've laid out, you can work with a party that can make the introductions for you, or you can work on it yourself. I will tell you that this is a very, very relationship driven business. And I'm sure your listeners know this. And institutions are not easy to get into. And everyone calls on these folks. You can pull lists of who they are. And there's a lot of folks knocking on their door. And I think what a lot of people have to appreciate is you only get one chance at a first impression. So if you're planning on going into a big institution and you don't know them, then you get one chance at that impression. And so you need to think about what you want that impression to be, right? And then once, if you get past your first impression, it's a good one. It takes time. It really takes time to do underwriting, and it really takes time to bring a new relationship into the fold. So the one tangible piece I can give advice on that is to start, if you want to access capital, broader capital sources, you have to think about way in advance from when you actually need it. Do not wait till you need it, because if you've waited till you need it, you have waited too long. You have got to be forward thinking about this and decide way in advance that this is where I want to be, this into the future, which means I need to start making a commitment and really work on doing that today. And whether it's, you can hire a capital raiser in house and have someone do it in house, which is not an inexpensive exercise. You can hire a firm like ours, which is also not an inexpensive exercise. They probably take the same amount of time on the relationships, right? Or you can just do it yourself and say, I'm going to start dedicating my time and I'm going to run my business, but I'm going to carve out some time and I'm going to take the time to do it myself. All of those options are available to you. And it comes down to how much money you want to spend and how much time you want it to take.
On a related question, have there been specific networking groups, experiences, conferences, any impactful things like that that have been especially impactful to your success?
Yeah, so we as a firm, PRIA is probably the biggest conference that is done in the private equity space, the real estate management space. You
Say
have
the name of
think
the conference again.
It's PREA, PREA. It's actually in Nashville. It's coming up here in a couple of weeks. It's a very big conference. You have NMHC for multifamily. You have ICSC for retail. But these are big conferences with a lot of big institutions go to them. You can get involved in UIL, Urban Institute. A lot of owner operators are involved in those as well. Or you can, to tap into your own network, be on social media. I'm a very big social media advisor for folks to use it. It is the easiest way to tap a broader network without you having to be in front of them yourself, right? It's about part of the battle is being visible, right? And being visible. And I still believe that you need to get out and meet people. You need to go out and see people and you need to be persistent and you got to show initiative and be persistent about it.
Have there been any books or resources that have been especially impactful to your success on your journey?
I read years ago, and I still think about it a lot because I use the word a lot. Is I read the word grit by Angela Duckworth,
Mm-hmm.
and I use that word all the time, particularly for hiring. And folks ask me, we're being a women-owned investment bank, and I think we're probably the only one there is. And we went through the GFC through today, which is a little dumb, but we survived. It's that you got to have grit and you got to be able to switch gears and to be able to adjust to the market environment and getting caught up. And I see mistakes like this all the time in companies we work with, that if you get caught up on what worked yesterday, it may not work today. And so you gotta, as if you're in charge, you gotta figure out how to continue to evolve and to continue to adjust, or you're just a guy with an idea that nobody's interested in, right? And it's the same thing, as you grow your business, that maybe your early employees are not the same people. They got you here, but they may not get you there. You have to continue evaluating your business, evaluating your team all the time, and figure out it's what's going on in the world, having your eyes wide open and not be too wed to anything, right? Because the real estate business changes all the time. And I can tell you now, a deal that I would have approved as an assignment a year ago or even 6 months ago, I might not have approved that today because the world's changed. And it's a little bit, and I face this internally all the time. Like, well, hang on a second. You said, well, the world's not the same it was 6 months ago, right? And so we got to move with the times. And I think that's why our success rate is pretty high on getting through things. It's that you got to be aware, you got to talk to people. And when they disagree with you, instead of saying, well, I don't agree with you, say, well, why is that? Well, why do you think that? It's paying attention and listening up and taking that information and constantly processing it. And remember that the world is changing. You got to change with it.
Valuable advice right there. I was just taking a bunch of notes while you were talking, so thank you for that. Deborah, I'd be remiss if I was talk to someone in your position and I didn't ask for projections. So we're nearly a quarter of the way through 2024,
Hmm.
unbelievably. So talk to me about your projections, what you're expecting
Hmm.
in the commercial real estate world for 2024 and beyond.
Yeah. So, what I'm expecting it for us at least is we had our biggest year in business last year, which sounds odd given the market.
Congratulations.
It was our biggest year last year. So I'm very proud of our success and proud of what we've done and what we've achieved. And I think in part it is by thinking forward, is where we think the world is going and where we think the change is coming. I expect corporate activity still to continue to improve in 2024. I think services businesses are commanding improving valuations. People want to get closer to the property. And so that so things like property managers, facility management, things like that are becoming the eye of folks looking to expand. I think product development, people are going to continue to figure out how to grow by investors, product, or geography. That's all at the corporate level. At the asset level, it'll be interesting to see how the trends play out. I think the housing problem is going to have to force solutions around how we get new product out of the ground, both development as well as existing product, so that it works for investors as well as tenants. I think what we learned over the past 3 years is people are interested in ESG up to a point. I'm not sure a lot of them are really willing to sacrifice market returns. So we know that now. So if we know that, what are we going to do about it? So there has to be a solution there. I think the chase on logistics and last mile is going to continue to evolve. I think the collapse and the focus of people coming into the space is going to continue to grow because I think we've realized that investment management is very sticky and it's got a lot of recurring income. And in tough times, we're realizing it's counter-cyclical, and in a great market, it's very profitable. And so we're seeing a lot of owner operators as well as institutions looking to figure out how to play in the investment management business. I think at the asset level, it is a little tougher. And my fear is that we got to pay attention to it pretty closely. Is if interest rates, it's an election year, so I'm pretty confident that interest rates aren't going to go up. That's my prediction in an election year. But if we don't get some correction on capital markets, if we get some pressure on the supply side from NOI or from macro or from micro factors, what happens? Does the transaction market continue to stick? Or do we end up, yes, supply may have adjustments, but demand wants to adjust even further. And so I think there's a lot of uncertainty in the transaction markets as a result, depending on the sector you're in.
Deborah, this has been an extremely enlightening conversation. I've thoroughly enjoyed it. I'm grateful for you sharing your time and expertise with us today. If listeners want to connect with you, learn more about you, learn more about the CenterCap Group, where would you like to send people?
Sure, you can go to our website, which is centercapgroup.com. We're also on LinkedIn, and I'm on LinkedIn. I'm very easy to find.
Perfect. Deborah, thank you so much.
You're welcome. It was great to be on the program.
Listeners, if you enjoyed this conversation, feel free to reach out to either one of us. We love talking about this stuff and we would love to connect with you. Thank you so much for listening. Until next time, take care.